Morning, everybody. Welcome to Friday. Sorry about the slight aberration in our plans this week, as it turned out to be totally unnecessary. Morning, Mike. Morning, everybody. Wow. Well, a lot going on, as usual. Where's my browsing on? Hang on a second. Wrong side. Let's knock him over here. Okay, let's open up the FT. Yeah, quite a lot to talk about. Hi, Jeremy, Jeffrey. Hi, Daniela, David. Yeah, it's quite a busy sort of end to the week, really, although the focus isn't really just on data per se, although I have to say the data has just been pretty dire, to be honest. We look at what's coming out with worse than expected employment data yesterday. We had retail sales that was worse than expected. It's been a pretty dire week, really, for data. Not just that, we are in the grip of credit rating downgrades for the Spanish banks. We've had Danish banks were downgraded overnight. There's a lot of it happening at the moment. So I've written down 4 things to focus on, that you need to focus on. First of all, you've already heard about the quarterly expiry. There is a bit of a misunderstanding about what this quarterly expiry means and why should we care about it. If you're used to spread betting, a lot of trades, especially if you're doing what a lot of us do, which is to day trade, typically we're pretty much flat at the end of the day, so we don't have anything to sort of consider in terms of rolling. But a lot of business is transacted on the futures markets and on the derivatives markets, and this is where companies and institutions, funds, hedge funds, etc., this is how they manage their risk. And what happens is there's a quarterly contract, March, June, September, and December. There are 4 quarterly contracts, and these contracts expire. And when they expire, they have to be rolled over to the next one. And it's the process of doing that where you have what's called futures, you have options on futures, you have individual equity options. So all these contracts have to be rolled over to the next month. And this is what all this hullabaloo is about when we talk about the quarterly expiry. Now, there have been some occasions in the past where the quarterly expiry has created massive flux in the market. I do remember this. In fact, June 2005, there was actually an investigation by the Financial Services Authority and the London Stock Exchange when the markets just went nuts in the expiry time, which is between 10 past 10 and 10:30 today. And that is when they settle all these contracts out. The reason why there's volatility? Well, what typically happens is, for instance, you can imagine in a bear market like we've been in, a lot of big funds, they may be tempted to sell the September contract. So we got the June one expiring. They will be tempted to sell a contract in September to get their hedge on September and run their June at the same time. And then they'll be looking to cover the June in the run-up to expiry today. Anyone who hasn't really covered by now is running quite a risk, of course, and most funds will have covered, at some stage during this week. This is the reason why the expiry week, as it's called, a lot of professional traders avoid trading stock index futures and options and those sort of contracts. But that's because they deal in quite big size. It doesn't typically affect what you and I do, really. But anyway, that's the sort of quarterly expiry. It happens, obviously, in the UK, US, and Europe. So it's quite a big event, and it can disturb the markets. Okay, so we have that. We also have the aftermath of the Spanish bank bailout, the bailout that the Spanish government refused to acknowledge as a bailout. But as I said to you on Monday, I knew exactly what it meant, and all the chickens have come home to roost. And the debt has been added on to the pile of Spanish sovereign debt. And the rating agencies have reacted in, the way they would have to. What I've actually got here is a chart from Bloomberg. You can get this. It's very easy to dig out. It's all freely provided on the internet. This is a chart of the yield on Spanish 10-year bonds. As you can see, it's rising. I'll do one over the last week. No, I won't. I'll do one over the last month. You could see that the yields dipped towards last weekend as the rumour abounded that there was going to be a bailout, and the reaction was, must buy Spanish bonds. It's going to be good for Spanish bonds. Then when the bailout happened, as you will have been reading in the press, the yields have risen and risen significantly. And yesterday, they actually hit close to 7%, which is just unsustainable. So it's pretty critical, really, for the time being. What's also happening is that we're noticing a rise in German Bund yields as well, and UK yields. So there is a concern that it could affect Germany as well. Germany is basically the one with the only country in the Eurozone with money, or a decent amount of it, and all the sort of responsibility seems to be falling on them. So you can see how this might eventually catch them out. Greece, Portugal, Ireland, that's not such a big deal. That wasn't ever going to affect Germany or France. But Spain, lot bigger deal. 40 million population, it's got a pile of debt. Really, that is something that would create a lot of indigestion for Germany, should that have to be bailed out in any way. Added to that, we have Greek elections this Sunday. Greek elections, it does make me laugh, and I don't know whether I can get hold of this. No, I don't. No, I haven't got it prepped up here. But there was a Business Insider article I was reading this morning that states that Greece has banned the publication of opinion polls in an attempt to prevent a nationwide panic and a run on the banks. The article goes on to say, so far it's been unsuccessful. The fact of the matter is, Greece enters into this election on Sunday, and the reason why the markets were jittery prior to the sort of run-up to this is that the fear was that the Syriza party, this is this chap, what's his name, Alex Tsipras, he basically wants to end the memorandum deal with Greece's international lenders, which has really helped push the economy into a depression, and he's saying it won't last beyond the weekend. The big irony with this Business Insider article is that they state that the opinion polls have been banned, and then they go on to say that that the two parties, that's the New Democratic Party, which backs this 130 billion euro bailout that is keeping Greece afloat, effectively, they're running neck and neck with the leftist party, Syriza. Now, if that's not a poll, well, what is? And then they go on to say, our poll shows the picture has not changed much since the last polls were published. But there was a rumour on Tuesday, for example, that making the rounds that Syriza was leading by a wide margin. But that's not actually happening at the moment. The big irony, actually, I think in Athens yesterday, the stock market went up 10% on the back of rumours that the New Democratic Party was pulling ahead. Now, you can understand why. The Greeks wanted to ban the publication of opinion polls if it causes that sort of a move. But we have a lot to be careful of early next week. The result of this election will be critical, but it may not yield an actual answer for us, I'm afraid, because it's likely that the president of Greece will then ask, the parties involved to try and form a coalition, because no party will get overall control, and it's just a question of then waiting to see what actually happens. So I'm not sure that there will be a bloodbath on Monday. I don't think there will be a decisive result, and my suspicions are that this chap from the Syriza party will end up having to compromise his position. Who knows? He's 37 years old. Maybe he thinks, hey, if I don't have it this time around, I'll have it another time around, and maybe he feels he doesn't need to compromise. But we shall wait and see. Now, the question is, and I know you're all probably wanting to ask it, so why are the markets going up? Why have they gone into risk-on mode? Risk-on mode being, the bonds down, equities up, dollar down, commodities up. What have we got here? These are the commodities. Well, you can see commodities have started to turn. Where's my correlation page? Okay, there's another one here. Well, here you can see quite clearly equities, FTSE bottom left, up quite sharply now. I say sharply, talking my own book really, but certainly there's been a bit of risk on. When I talk about risk on, I'm saying people are putting money back into the markets. Middle top, obviously we all know about, these are all daily charts by the way, middle top, you can see the dollar losing ground against the euro. So we hit a low back on the 1st of June when we actually hit, I think, I'm not sure we got, do we get down there to that level, 122, 123-ish? We're now trading 126 and change. So certainly going against what you might think could happen to the euro should it go disastrously over the weekend. But as I said to you, that ain't going to happen immediately on Monday or even early next week. So very much perhaps a little bit of profit taking, etc. But you can see the trends here, and you can see the trend in the bond markets as well, although I haven't got one up here. Let me put up our German Bund if I can get it, and you'll see what's happening. GBU2 DT. Okay. So bottom left, bottom right, this is the German Bund, and this is the reaction. So we've had a long run up in the German Bund, and now, over the last 2 weeks, the markets have started to realize what effect it could have on the German Bund as well. But in fact, there has been a general sell-off in bonds over the last week and a half. So, and that's, as I said, in line with a rally in the euro or a sell-off in the US dollar. So a little bit of risk on mode, but don't misinterpret it. It's probably more a little bit of backing and filling and profit taking on the risk off. And there is a sort of a more natural move to go into risk on, obviously, with rates so low. So, what else is happening then? Well, other reason why the markets are rallying, of course, is that there's a lot of reports, and I'll have to see if I can get one of them up on my browser here. Markets. Okay, so hopes mount for central bank intervention. I've got reports from, what's this one here? This is from Reuters. Central banks ready to act as poll. World prepares for a Greek poll. Stocks rebound on hopes for stimulus. So really what we're looking at here is a possibility that the central banks and governments are preparing for the aftermath of the Greek election. Quite what they can do, I'm not altogether clear. Certainly sterling's been particularly weak, and I know you were listening to Adrian explaining some of that. Mervyn King stated last night that he thought that there were increasing arguments now for additional stimulation for the economy. That can't be an interest rate cut, although Lagarde was pushing for the UK to cut its rates from half to quarter. Just ain't going to have any effect. Really, it's the QE, but the QE quantitative easing has diminishing effects, really. But that was the rumour or the comment last night, and the belief that will be happening sooner rather than later in the UK. So, so interest rate cuts, QE, possibly early next week, and it looks like this threat of coordinated intervention is supporting the markets for now. That's pretty much it. I was going to go into an explanation of how the credit rating agencies work, and et cetera, et cetera. I think we've sort of probably done our time here a little bit. I think we want to get back into trading looking at the charts again. John, that's very kind. Very interested in trading treasury notes, 2 and 10 year. Do we have fees for these within Ensign? John's asking about the treasury prices. The treasury prices, these are the prices for the notes, bills, bonds, etc. from the US. That's the equivalent of our gilts, or the equivalent of the German bunds, or the equivalent of the Spanish bonds, etc. John, I actually pay for my data through eSignal. I'm not sure that you can get that data on Ensign, certainly not for free. If you have a data feed, I'll basically show you, for example, on this, if you go to Setup, and then Connection, you'll see that I run eSignal here. And if you have, if you've got it, then what I'll do is I'll get an email to you with the codes for the instrument codes. The best thing to do is probably just look at them in a delayed basis initially, because you can get that for free, John. And then when you're happy with what you're looking at, then you can pay for it. I mean, it's not that expensive, but like with everything, if you paid for all the data, you'd end up forking out thousands of dollars a month, which is not really worth it. Okay, that's pretty much it for now. Listen, it's Friday. It's going to be an interesting day, but please just be very careful. You can get some really weird swings. Yeah, a lot of what's happening, may not make sense to someone looking at the markets now, knowing what the fundamental backdrop is with the deteriorating economic picture globally now, and the potential breakup of the euro. You would not expect to see what's happening over the last 2 or 3 days, but that's why it's very important we trade off price and not try to analyze fundamentals. Yeah. Okay. Thanks very much for listening for today.